Joining us now is Jim Bianco of Bianco Research, Invesco's Alessio de Longis, and Victoria Greene of G Squared Private Wealth. Victoria, I want to begin with you. We've had a massive year of gains on the S&P. We had a big one last year too. And a lot of people are starting to come on the show and say we can't repeat this act next year, the year after that. Do you think we can keep climbing this wall of worry?
I do. I'm actually fairly bullish on the end of the year. I mean, you look at all the different catalysts that are there with EPS beats. I mean, earnings season was fantastic. Yeah, you had a couple notable misses with Apple and Amazon, but across the board, it was like a 85% beat by almost 30%. It was pretty incredible. And then you have the Fed coming out like with the most tepid, hawkish, maybe we're going to start tapering. Please don't be scared. We are going to start tapering, but it's going to be super slow. And we aren't even ready to start talking about rate increases. I look around and I don't think there's anything to knock this bull run off right now. Obviously, something could come out of left field. You know, everybody loves to talk about China right now and the debt crisis over there, and we'll see if they make their bond payment today or not. And certainly the Fed has outlined all those risks in their book on what could derail the markets. But look around and it's all fairly bullish. I know everybody's nervous, but this is where you make money.
You're not a doubter. Here is a doubter. UBS, they say the following. Further tightening of financial conditions, continued cost pressures, slower growth in the second half of 22 point to a flattening of EPS growth thereafter to below trend levels and a more notable multiple derating. Jim Bianco, your view on this right now?
I agree with that. I think that there's going to be a lot of headwinds that we're going to have to move into 2022. And the biggest one is going to be whether or not inflation is persistent. And because if inflation is persistent, the Fed is going to have to start to taper faster, maybe raise rates more than one time, maybe as many as 3 times next year. The market's already got 2 rate hikes priced in for next year. So I know that most people on the street are on the first stage of grief. They're in the denial stage about that the Fed's going to get aggressive next year. But if that type of aggressive action is still priced into the market into the beginning of the year, I think we're going to run into headwinds. Now, if inflation is transitory and this dissipates and the Fed can slow down the taper or maybe just taper and do nothing else, then the market can move higher. But right now, the odds probably face more headwinds, I think, than tailwinds as we move into 2022.
It's amazing how quickly one thing you've picked up on, though, the potential reacceleration in this economy. Alessio and Jim talking about this return to trend, this deceleration through next year. Jim, I just wonder in the near term, do you think we can have some form of reacceleration here? The ISM last week, tremendous. The jobs report, Victoria pointed out, fantastic. Can we get that kick higher again?
Oh, yeah, I think we can. The economy's got, some momentum to it. And also from a market standpoint, there is, a record amount of cash that's sitting in checking accounts, $3.5 trillion, up from $800 billion just a year ago. I know I've been in this market for over 30 years, and every day for 30 years, everyone said there's all this cash in the sideline. That's not been true until a year ago because no one spent money in 2020, and we had all the stimulus checks. Everybody's been busting at the brims with money in their checking accounts, and that's showing up in one of 2 ways. Markets are powering higher, and you see it in the indexes like the S&P 500 outperforming because in the retail world, there's really only one thing to buy, and that's the index fund. And people are buying stuff, and we've got the supply chain, running at capacity right now, and we've been talking about that, incessantly for the last couple of months. So that dynamic can continue at least until the beginning of the year. The only thing I think that upsets that, other than an exogenous shock, would be much higher interest rates. That's not quite in the cards just yet, but it could be later on in 2022.
We'll talk about the rate story. Reporting here at Bloomberg suggesting that Governor Brainerd has interviewed for the top job with the president. Michael McKee joins us now. Morning, Mike.
Good morning, John. This has more implications for the Fed than people realize. Now, if you take Jay Powell as the new chairman or the reappointed chairman, and Lael Brainerd gets another job, say the vice chair for supervision, you're not going to have a major change at the Fed, and those two could get through fairly quickly because they've already been confirmed. They're already on the Fed. So that could be reasonably fast. You still have to replace Clarida and Quarles, and there's still an open seat. But if Lael Brainerd is selected as chair, then one would assume that Jay Powell would resign. And that leaves 4 open seats on the Fed, and that does have implications for the Fed. Not necessarily an implication for policy, because at the zero bound, it's pretty hard to get more dovish than the Fed already is. It could create, over the long run, a more dovish Fed, but we don't know how the economy is going to evolve. It could mean tougher bank regulation with Lael Brainard as vice chair or as the chairman. That could be a change. But in politics, it tilts the Fed heavily toward the doves if Biden nominates a number of Democrats to those 4 open seats. And it would probably make social and climate policy more important. For the Fed, though, it would leave them shorthanded because this banking committee isn't going to take nominations and get them through within the time period before all these people leave the Fed. So the Fed goes into 2022 shorthanded. There are 2 regional seats already open, as we know, John, and 2 more coming at the end of 2022, Chicago and Kansas City. So you could have a very inexperienced team shorthanded for 2022 as the Fed tries to continue managing the recovery.
At a critical juncture as well, Mike, it's worth reflecting on the fact of how wrong we have been in the past on Fed chairs. There were people who thought Chair Yellen would be more dovish than Chair Bernanke. It turned out, in fact, he was actually a little bit more hawkish than many people expected. People thought we'd have a hawkish Chairman Powell. He did a huge 180 after the back end of 2018. Mike, we can be very wrong about this stuff when we try and war game it out.
Yeah, because we don't know what's going to happen to the economy, and that's basically where we were. We didn't know there would be a great financial crisis, and Ben Bernanke would be in charge of the Fed, a guy who had studied the Great Depression, and we didn't know that we would have the current crisis when Jay Powell was selected as chair. It's more that the economy makes the policy than the policymaker brings in a predetermined desire to do something or other.
Mike McKee, thank you, sir. As always, stand on top of this story. Mike, we'll catch up with you a little bit later. Jim Bianco with us, Alessio Longis, Victoria Greene. Jim Bianco, I know you have thoughts. Share them, please.
Yeah, so I
think that...
Go on, Jim.
Okay, I think it's 50-50 that Powell gets reappointed. I think it's that close. I know the betting markets have them more at around 65 or 70%. I'll even go you one step further, John. I'll say that the administration doesn't want to appoint Powell, but they might feel compelled to appoint him because the banking lobby is going to push back hard against Lael Brainard because of banking regulations. It's correct to say that there's going to be very little difference in monetary policy between a Brainard and a Powell, but banking regulations, and if you add in Amarova over at Office of Control over the Currency, that is a big deal for the banks, and they're going to push back hard on her. So I think he'd like to not appoint Jay Powell, but it's probably even money right now. And we're already at a record. The latest that a Fed chairman has ever been nominated was November 2nd. That was Powell 4 years ago. It's November 9th. And so he's taking a tremendous amount of time to do this, suggesting how uncertain this whole process is at the administration.
Victoria, I know you have thoughts as well. Is there a reason to believe that real yields are going to change anytime soon? Had a fascinating conversation recently with PGIM's Mike Collins on this. Take a listen to what Mike had to say.
A negative 1% real rate is where it's supposed to be. That is actually fair value. Investors who are flush with cash are not supposed to earn a positive return over inflation by sitting in cash and treasury bills, right? They're supposed to pay to store their money. That's the world we live in. So that is a normal relationship, and that is good for valuations, right? It continues to support higher than historical equity valuations.
Jim Bianco, what do you make of this argument? You do not deserve a positive real yield on the risk-free asset. What do you make of that?
I think that's been a correct argument and probably will be a correct argument as we move forward. But underlying that is an assumption of transitory inflation, that the negative real yields that we're seeing, especially the record negative real yields we're seeing, will come down because inflation will come down. Now, if inflation doesn't come down into 22 and 23, then I think you're going to start to see a sign that we're going to start moving to maybe zero real yields or maybe positive. And if the bond market is giving us a signal that that might be happening, persistent inflation is coming that very few people are talking about, it's been the carnage on the front end of the yield curve. Bloomberg has reported a lot of levered hedge funds had a terrible month in October because short-term interest rates, the two-year note yields around the world, shot up quite a bit, and that shocked a lot of people. And I think it is a signal from the market that eventually the Fed is going to have to get a lot, or not even Fed, central banks around the world are going to have to get a lot more aggressive in raising rates. And when they do, I think you're going to start to see the dynamic in long-term real yields change and go less negative, maybe to zero. But again, that's going to take probably the balance of 22 in order for it to happen. It's not going to happen right away.
Fantastic quarter.
Well, with that in mind, you'd expect the index to struggle. And the index hasn't struggled. Amazon is about 4% of the S&P. It's been struggling with labour costs. The likes of Apple struggling with supply at 6% of the S&P. And here we are at all-time highs. Jim, I often go back to this. What's behind an equity market rally? And you and I have discussed this a million times. You start with price and then the narrative comes. It's born out of where the price is often. And for a lot of people, they come on the show and they talk about where the market is and they give you this fundamental thesis as to why we're there. Mike Wilson of Morgan Stanley is saying this is down to, not exclusively, but a lot of it is down to record retail passive inflows this year. It does not reflect the fundamentals elsewhere. Does that resonate with you, Jim?
Absolutely, it resonates with me. It's almost obvious when you look at the data. You've seen record flows into the index funds. You've seen the outperformance of the S&P by something like 15% over the Russell over the last 6 or 9 months. The only time that's ever happened in history is when there's been a full-out bear market, when the market's down 20 or 30% and everybody hides in large cap stocks. The concentration of the index in the S&P is the most it's been since the 1960s. 5 stocks are a quarter of the index. So as I like to jokingly say, what's going on in the market? As long as there's electricity on the New York Stock Exchange, people put money into the stock market, and that's one instrument. That's the S&P 500. And then 25% of that goes into 5 stocks, and then that just feeds on itself. And there's a lot of money still left on the sideline that can continue to come into this market until something upsets that. So I'm in complete agreement with that idea that you've just got a giant flow of money, and that's why the valuations will matter later, but they don't really matter right now.
Alessio, final